Hey everybody, Preston Bryn here with our Trader User Group Weekly Roundup. This is for the trading week ending September 4th, 2015. Well, for those of you in the United States, you should have a nice long and probably welcome relief with a Labor Day weekend holiday. Just as a quick reminder, some markets will be open Sunday night, trading on Globex, some of the futures markets, but then they'll close Monday morning, and then the rest of the day, U.S. markets are closed. All equity market trading in the U.S. is closed for business on Monday. China, meanwhile, was closed Thursday and Friday for their illustrious military parade, but they're going to open back up Monday. So it's going to be an interesting week. It'll be a short week next week, and then that leads into the all-important Federal Reserve FOMC meeting on Tuesday and Wednesday the following week with an interest rate statement, policy statement, and probably an economy statement by Yellen. Now, what I've got on the screen here is a weekly chart of the E-mini S&P 500 futures. And I wanted to show you some potential, a good news scenario and just an average medium term and then a bad news scenario to see which one is going to shake themselves out. And you know, it's really interesting over this week and this weekend, anytime the markets pull back more than 5 or 6%, out they come. The emails, the TV talking heads, you've got some on one side of the desk saying we're going a lot lower, you got others saying now's the time to buy. Meanwhile, all of you retail traders out there, most retail traders are just going, what the hell? Do I get in? Do I stay out? What's going on? Well, no one knows for sure, but what I want to do is just give you a way to take a look at the tea leaves, take a look at the charts, and based on price action and some very key levels, they're going to kind of depict whether you should be really worried and just play it to the downside or go to cash or start buying because we're going to go to a bounce. All right, so let's start first with the E-mini S&P 500 futures, the weekly chart. As you can see on here, now, if you're not a member of our group, I highly encourage you to come in because this was not a surprise to our group. Obviously, the severity of the downdraft was no one expected volatility to move up in a short period of time like it did. In fact, it was a record for the markets. But if you look at the weekly chart, you're going to be able to see here that going all the way back several years into 2013, we had this higher channel that we were playing in, yet we were making lower highs on strength. Now, I can show you also the RSI, and it was doing the exact same thing. So a lot of you may not have the same system I have, but the RSI is just as good at looking at and measuring strength. And as you can see here, even on the RSI, right? I mean, even looking at the RSI, and this is a weekly chart, keep that in mind. On the RSI, we had this channel moving like that while we had a channel moving like that. So the difference between those two is what we would call a bed or a bearish divergence. And anytime you get something like this setting up, then watch out. A bearish divergence does not tell you when it's going to go down. So you just got to be prepped for it. And it does not tell you how far it's going to fall when it does. But these two are givens. It will go down and it will happen over a certain defined period of time. As you can see here, we actually started this divergence back in the beginning of 2014. That's when we started in earnest, and then we just kind of marched to this wall of worry. I also showed our members the lack of breadth in the market with the percentage of S&P 500 and Nasdaq stocks that were over and under their 50 EMA and their 20 EMA, and it looked atrocious. It looked just like this RSI as the market went higher and higher. So these are early warning signs that we all saw, okay? But let me show you something else on here just to kind of give you an idea of a headline number of where the markets could go. Now, this is a weekly chart, so I'm going to blow it up just a little bit here so that, you know, for all of you with bad eyesight can see this darn thing. Let me just stretch it just a little bit here so it'll kind of stand out for you. Now, I'm going to do a couple of different numbers here, but the first thing I want to show you is the low before we really had that big downturn. We had a low in January, actually January the 12th, we had a low. It was right in that area there. And you can see that this low was immediately right there tested, and then it held. Okay, so that's a good thing. That was just, January kind of going along, doing its thing, not really going anywhere. And then we had another low that was, well, let me change, let me get my pen off here so that you can see it. We had another low that was right here, and this held up for an even longer period of time. So there were two major lows that we were watching. This one right here, early in January, that was the low for the year, right? Because January, if I kind of divide the chart and we look at 2015 going this way, you can see we kind of started off January into February down at the bottom down here, but then we quickly moved up. And then we defended this. Again, this is a weekly chart. So we sat here 5 weeks, right? Right, just kind of floating along down here until we finally took off. We made a new high here at 2134, and then we just slowly kind of drifted. And I think during this period of time on a daily chart, we crossed the 50 EMA more than 30, 35, 30, 34, 35 times during the year in 2015, right? Remember, this is 2015. So we stayed there, and we came down and tested that low again that we made back in March. So we had really two numbers we were watching, 2032 and 1970. And then the market started to shift sometime in August, right at that bar right there. We attempted from here to make another high, but we couldn't make another high. All right, so we made a high here, and then we made a higher high here. That was 2134, and that was it. We made another run right there. We couldn't do it, and we started to roll over. Now, the minute we took out 2032.50, alarm bells were starting to go off, because that was a low that held up pretty much all year, at least through the middle of February, right, of 2015. And then we came down and we were looking at 1970 to hold. In fact, if you look on there, you can see we came right down to it. And we had this flash crash down here, but we came right back up, and we actually closed up above it right at 1992.75. So a lot of people said, well, hey, this was just a capitulation move. This is where we're sitting right here. Now, our group, and I was telling everybody we can expect another run back down here again. And that is where we are right now. In fact, we had this past week, let me just clear this chart up here so you can see a little bit better here. You can see on this past week, here's that bar right there. We're back down in this area right here again. So now the question is, how bad will it be? And there's different levels of bad, as you guys probably already know. And at least in living through where we've been for the past 3 or 4 weeks. So I would say the best case scenario for us right now is that we've got a couple of, and I'm going to switch to a daily chart, and I'm going to really zoom in on this so that you guys can see these levels, because they're very important, and you should write them down and just make sure that you understand where these levels are. Now, for our members, we're not meeting Sunday night for our weekly market watch. We're off for Labor Day. I'll be in our chat room, though, because we may have some futures trading going on Sunday night. I want to see what China does. But let's zoom into the daily basis here for a second, and let's just really take a look at this. So if you look on the daily basis, these are the two prior lows in 2015. Now remember, these prior areas were great for support, and what is great for support becomes great for resistance once it's blown through. And each one of them had a couple of touches or near touches. So 1970 and 2032 are going to be solid resistance points for us. We had this move up here, as you can see on this daily chart, and we broke through 1970, and we went all the way up to 1992. We had a 2-day solid rally, and now we're back down again. And you can see there's some indecision in these candlesticks right here. And I've also run off of this daily chart a Fibonacci, and you can see on this retracement here, on this Fibonacci, on just where we went. and where the potential best case scenarios can take us. And obviously, this 1900, call it 1904, it's at the 61.8% fib, seems to be holding up right now. So that is going to be on a daily basis one that we really want to see that it can hold. If this night, and call it 1900 because it's not an exact number, but we'll define it as a zone. If this can hold here, that's a good sign. But we're still going to need to come back up, take 1970 out, and take out that prior pivot high, which is 1992.75. If we don't do that, and we chop around here, and then we break 1900 and come down, we're going to test down in these areas down here, roughly 1850 and then down to 1830. So remember I told you best case, medium case, worst case scenario. Best case scenario is this with the charts right now. We've already had a pretty good little washout, but the best case scenario is this 1900 level holds. Okay, we kind of come around in this area here, and then we slowly work ourselves back up. We may chop around here, but if we can break that and then 1970 then holds, we'll make a run at 1992 and then hopefully get back up around the 2000 area. All right, so that's the best case scenario. So how do we measure best case scenario? 1900. It's either gonna hold or it's not gonna hold. Now I'm using a daily chart, so you want to see where the candlestick ends at the end of the day. Okay, and if we can hold, in other words, if the candlestick closes at the end of the day above 1900, that's a good sign. If it doesn't, and we close south of 1900, then we're going to come down and test these lower points here, 1850 and then 1830. All right, so that'll be a little zone that we're going to come down and then provide us a little interim area of test. Okay, so again, 1900 is going to be key for us. We got to watch that. Now, what is the medium? And this would be a medium case scenario testing this. The next one down would be, and let's just zoom back out, and this is what I'm telling our group is our line in the sand, and if we break this, it's going to get very ugly. And the line in the sand for us is the October lows right here. And if we look at the October lows in the E-minis, you'll see they're fairly close right now to the lows that we made on that washout on Monday when we just crammed and jammed everybody that had sell stops, automated sell stops. They all got triggered and they lost a lot of money. You can see right there 1830, which is where we went to on that one bar, but just below that 1813. So that is the October 2014 lows. And this is going to have to hold for us. That I call it our line in the sand. So this would be the medium case to leaning towards worst case scenario. And I'll show you the worst case in a minute, but this has got to hold for us. So number one, we want 1900 to hold. If it doesn't hold, it's going to break, and we're going to come down and test this wide zone down here from about 1850 down to about 1813 roughly. So it's a wide zone because we got a lot of volatility in there. Okay, so this would be best case scenario. This would be the second case scenario right here. So best case right here. If that holds up, that's good. This is the medium case right there. Not really sure, but if it holds, it's going to give the bulls a lot of confidence. If it can hold here, we move up and then we pull back a little bit, but we start making higher lows and we start to form the basics of a channel to work back up in this area, back up here again. That's assuming we get down here. Okay, so that would be my medium case scenario. Now, worst case scenario, what's that? Well, I'm going to go out to a monthly chart on this, and let me just delete these that I just drew in here, just so that I can clear them up for you. And we're going to go out to a monthly chart, and I'll show you a worst case scenario here. If we come out to a monthly like this, you can see here on this monthly chart, and I've got an Elliott wave count here too. On this monthly chart, Let's just go like this. Excuse me. I have to sneeze. Excuse me. All right. On this monthly chart, I'll show you a worst case scenario. You can see I've got an Elliott wave count here. On this Elliott wave count, you got a 1, a 2, and a 3, and we're looking for a 4 somewhere down here. Now it can be a very short 4, it can be a long 4. This is a very elongated 3. So when you have a elongated 3 leg and a very narrow short 1 to 2, we're going to have a narrow short 3 to 4. And then we're going to have a short run for 5. Okay, and it's debatable whether 5 takes out the 3 high here at 21.34 or not. But right now, be that as it may, with an Elliott wave count of a 3 working on a 4 leg down, one thing I'm going to do here is let's go back and look at this, and I'll look at the worst case scenario here. So let's take it way back, and then I am going to put on here some highs here that were made in the dot-com bubble back here in 2000, and roughly we hit here again 1574.25. Again, this is a monthly chart, okay, and you can see on this monthly chart that I don't have bearish divergence. I mean, the one good news is I don't have bearish divergence, and what I'm referring to here is I don't have bearish divergence from here to here and to here. It's roughly about the same, okay. So what I'm going to do is I'm going to run a Fibonacci, and I'm going to show you guys this would be worst case scenario. So just, hang on to your seats here and just kind of project what happens if we get worst case scenario. So what I'm going to do is I'm going to come to the lows, March 6, 2009, which I remember very well. And for members in our group, we started making some great money in April and May. We were going long the markets, having a great time. But if I come up roughly, I don't need to come up exact, but you'll get the idea, right? So let's just come up right about there. Now, take a look at this, guys. And what do you see? I ran a Fibonacci extension. And Fibonacci is a measure of fear and greed, human profit taking, human fear, all encapsulated in a ratio that measures human psychology. I'm not going to go into the background of Fibonacci, but suffice it to say that worst case scenario, we come back to the 38% fib level, which is also the previous highs that were made for the dot-com bubble in the E-minis and in Nasdaq for that matter, and also in the 2007 scenario. So let me just move it over, slide it over here. So here we go right here. Now you can see everything. I had to just move it a little bit so you guys could see what I'm talking about here. But you can see in the dot-com scenario and back in 07, I mean, just perfect. And now look at the Fibonacci, 1574 and 1574. Guys, that's just, it's eerily close, okay? So we've got an area here. If we take out the October lows, by the way, which is 1813, which is just north of the 1788. So if the markets are moving fast, it'll hit 1788 and bounce and move back up. So remember, this was our best case scenario was that 1900 holds. That was our best case scenario. That holds up, and then boom, we start making higher lows. The next case scenario was right around this 1820 area, roughly, give or take, because of the markets. And then that would be our best case scenario. Worst case, or our second case. Our worst case scenario is we come down here like that, and we test this fib area right here. Now, I don't think it's going to go lower than that. I may be wrong, but that's where we'd be looking to be. If it comes down here, I'm going to be a heavy buyer, okay? If it comes down here, I'm going to start nibbling. And if I see we start to make higher lows, then I'm going to start to nibble even stronger. So I wanted to show you exactly how this market is starting to time itself out, okay? And remember, monthly charts have a dramatic lag to them. I mean, literally up to 3 or 4 or 5 months, which is only 3 or 4 or 5 bars. But I wanted to show you that fib and and the 38% retracement is a normal fib, guys. It is a normal Fibonacci move. So it would not surprise me at all to see that. All right, wouldn't surprise me if it gets ugly, and let's say China comes out and then they start reporting what their real GDP number is, which is probably closer to 4% instead of 7%. You'll see the markets give up another 5 to 7% in less than a week. Maybe even quicker. So guys, just keep these numbers in the back of your mind. All right. So if we come back in and let's go back to the daily again, you can see that Fibonacci on that monthly chart in green right here, right around the 1789, 1790 area, which is just north of that area there, which is just south, which is just south of the October lows. All right, so that's where we can go. I personally believe, and let me just take this off the screen here for a second, and then I'm going to put my indicators back up here so that you can see exactly what I'm looking at, what our members are looking at, and I'm going to take it down to a 2-hour chart. All right, so let's do this, and let me put my indicators back on the screen. Now it's very busy, so I wanted to start with a clean chart first. And again, if we look at the E-minis, you can see I've isolated this movement here. We had a good run back off the screen here. You can't, well, let me turn my drawing tool back off again, and then I'll show you. We had this really good run right here in this channel. And it was a good pick, and we had a bullish divergence. The minute we started this run, we got into it in the lower part of this channel and rode it all the way up. And then I said we can expect a counter trend, which is what we got right here, a counter trend within a counter trend of an overall downtrend, if that makes sense to you guys. All right, so this is where we're sitting right now. 1831 is the low for the year, that red line right down below there, okay? So now, if we look at this chart here, you can see this is what we were watching going into close on Friday. I'm looking at this. Well, let's get it back up here again because I moved the whole darn thing. Let's see here. Let's get it just like that. We'll level it like that. There we go. So you can see right in this area here, this is kind of what I'm looking at to hold, as I said before, right around that 1900 area. I want this to hold. You can see it held there and it held here, right? So these two areas. And although we did not make a lower low there than we did here, we got a little bit of a bullish divergence, but it's not the ideal bullish divergence because we wanted to make a lower low here, but we didn't do that. And now we're sitting here at 1900, just north of 1900. We had a little bit of a run in the last couple of hours of the day on Friday, and we're sitting just south of 1920. All right, you can see that's a pivot point or a price level resistance point for us. So we want 1900 to hold. Should it break, we're going to come down into this area right down here. Okay, you can see some interim checks right here, but if it breaks and it breaks hard, this is where we're going to end up down here. That would be the medium term, and then of course the worst is going to be coming down to that 38% fib level down around 1574, somewhere in that area there. It's just not going to be pretty. So that's what we're looking at on the E-mini S&P 500 futures. I'm not going to show the other indexes other than that they're all very weak. The chart looks very similar. If I look at the Nasdaq, which is the strongest of all the indexes, and I will just clear the screen again of my indicators so that you can see here. You can see that we had this hard move up, and now we're coming back down again. We're below the 200. We're below the 50. We're below the opening price of the year of Nasdaq. Again, not looking pretty. RSI below 50. So it's just not a good picture. You can see this blue line here that I put in. That was the opening price of Nasdaq for the year. The worst index of the year for 2015 is the Dow. The Dow is just very, very ugly. In fact, on the Dow futures, we had a death, or it's called a death cross, which is when you've got the 50 EMA crossing the 200 EMA. And as I told our members, anytime you have that death cross, go long, because by the time the death cross occurs, it's a lagging signal. And sure enough, if you look at it, it crossed right here on this bar, and that was the very time we started jumping into these longs for a couple of days, and then we topped out, and now we're back here again. So all the signals, all the indexes have this very similar move. Down hard, a little bit of a blow off like that, up a little bit, and now this is where we're sitting right there. Almost all the indexes look like that. So clearly that is going to be a low, and that's going to be another key low for us. And then will this go down and take this one out and start making new lows, or will it hold and start to come back up, take out that prior pivot high, and start making new pivot highs? So these are the scenarios that we're going to be looking at in this holiday shortened week coming up, Tuesday through Friday here in the U.S. markets. For our European members, we're going to be looking at the European markets, the Chinese markets, to see what's going to be happening. We're going to be looking at the euro and the dollar and the U.S. bonds. I think everything is elevated higher than it should be, especially the U.S. bonds. But at this moment, there's just a lot of fear in the market, and we got to see how this thing is going to shake itself out. Volatility is extremely high. We're playing volatility now and just nibbling on one of our favorite securities. Over the next 6 months, maybe even longer, 9 months, it's going to be a home run trade. Near term, though, it's going to be very difficult to time, but it's one that we're going to be playing for quite some time. Okay, so again, as we look at the Dow futures, we're hovering just above the 16,000 mark. We want to see that we can hold this level and then start to move higher. Also in our group, for those you, we've got moves in currencies that we've been doing, as well as in gold and silver. Oil has been an interesting trade. I think gasoline and oil are going to be interesting over the as we start to go into the winter months in the northern hemisphere. Agricultural products, we've had a couple of really good trades in those as well. Sugar has finally gotten off the bottom. It's moved a little bit. I mean, not a lot, but you can see this big move right here off the bottom. It's trying to recapture its 50 EMA. It's having a little bit of difficulty doing that, but it's made a nice move nonetheless. So that hadn't escaped our attention. All right, everybody. If you're not a member of our group, I encourage you to do so. We're bringing on a lot of European and Australian folks too. And we're going to be starting our trading in the commodities as well as some of the key indexes very soon. So I'm sure a lot of you are going to look forward to that. And if you're not, then come on, sign up, and I think you'll have fun with us. All right, everybody, I want you to have a great holiday long weekend. If you're a U.S. resident, for other members, I'll probably be in and out of chat, maybe Sunday night and Monday morning. All right, everybody, have a great weekend. Ciao.